Hello everyone, my name is Muhammad Yusuf bin Muhammad BB2110598. Let's start from question 4. If a deposit outflow of $50 million occurs, which balance sheet will a bank rather have initially? The balance sheet in question 3 or the following balance sheet, and why? For the answer, the bank will prefer to see the balance sheet in this problem because even if it lost $15 million due to deposit withdrawals, it will still have $5 million in excess reserve, $15 million in reserve less $45 million in necessary reserve, which is 10% of the $1,450 million in deposit. As the consequence of the outflow of deposits, the bank will not have to make any additional adjustment to its balance sheet and will not incur any cost. In contrast, the bank will have a reserve shortfall of $20 million based on the balance sheet in question 3, which is the $25 million in the reserve divided by the $45 million in required reserve. When the bank raises the necessary reserve using the methods outlined in the text, it will incur expenses in this instance.
Hi everyone, my name is Aina Nazira binti Nazalin and I will present the question 15. The question 15 stated that because diversification is a desirable strategy for avoiding a risk, it never makes sense for a bank to specialize in making specific type of loans. Is this statement true, false, or uncertain? Explain your answer. So the given statements stated above are false due to bank specialization in lending specified industries are also among the desirable strategy for avoiding a risk. A greater information regarding the industry the bank wishes to loan their money with, it will be more accurate to assess the value of a project the company is working on. Thereby, banks could avoid any unwanted credit risk before lending their money to the companies. Besides that, it will be more beneficial for the bank to assess the borrower's credibility, so it enables the bank to offer a final loan to the high-quality borrowers rather than the untrustworthy borrowers. For instance, a failure of repayment by the borrowers might interrupt the cash flows and as well as raising the cost of collecting the money back. On top of that, banks that specialize in industrial knowledge will more better at guiding and monitoring the borrower and lessen the credit risk of the loan. Next, it also can help cushion them against credit risk, operational risk, liquidity risk, and many more. The statements above are misleading, and banks specializing in making specific types of loans will avoid any risk.
Good day. So my name is Siti Nur Hidayah binti Musli. My matric number is BB211100044. So today I'm going to explain about questions number 16. The question is, if you are a banker and expect interest rate to rise in the future, would you prefer to make short-term loan or long-term loans? So for the answer, as a banker that expect interest rate increase in the future, I will be prefer to make a short-term loan. This is because short-term loan is more can prevent a borrower from bearing a high interest rate for a long period of time. Meanwhile, if the borrower choose long-term loan, then they will need to pay high interest rate for a long time period. So it will burden the borrower in the future. Not just that, by choosing a short-term loan, it will be incurring interest in a shorter time. The types of funding will be more easy and fast, and it will be easy to acquire. While long-term loan, it can only earn high return when the interest rate are interpreted to decrease. That's all from me. Thank you.
Greetings to everyone. My name is Kirtika Anupurupari Krishnan. My matrix number is BB211100717. So today I'm going to present question 17 and question 23. Now let's take a look at question 17. Bank managers should not always seek the highest return possible on their assets. Is this statement true, false, or uncertain? Explain the answer. The following statement is false. It is because banks must also consider the risk and liquidity of assets when deciding which assets to hold on to. In the case of risky assets, bank managers wouldn't want to hold them, even if they offer higher returns compared to the other assets. Therefore, bank managers must consider both the risk associated with the asset, liquidity of the asset, as well as the return on assets when deciding to hold an asset or not. Thus, the bank managers should not always seek the highest return that is possible on their assets, because they also have choices either way to not seek highest return or vice versa. However, bankers sometimes seek to maximize profits by maximizing returns on loans and securities, mitigating risk, and maintaining sufficient liquidity by holding liquid assets. Risky investment may offer higher returns opportunities than others, but the funds are put at a greater risk. Through diversification, banks protect themselves against the risk of unexpectedly high loan default rates and asset liability time mismatches. In other words, banks lend to large number of customers to reduce risk. This process is called as risk sharing. As banks diversify their lending, categories of borrowers with higher than expected defaults tend to be randomly offset by other borrowers with lower than expected defaults. Therefore, loan diversification helps banks to maintain a positive net worth, but diversification won't help in the event of a widespread recession. Furthermore, banks are limited in what they can do and what asset they can hold. In order to increase the credibility of banks, they are advised to limit risky activities such as holding risky assets, or at least from holding a larger than reasonable amount of these risky assets.
For the question 20, what happened to the reserve at First National Bank if one person withdraw $1,000 of cash and others person deposit $500 of cash? Use the accounts to explain your answer. Look at the table about the asset, reserve, liability, and checkable deposit. Due to the offsetting of a withdrawal of $1,000 and a deposit $500, the reserve account has a net drop of $500. The same is true for the account for checkable deposit, which will experience a net loss of $500 as a result of offsetting a withdrawal of $1,000 and deposit all of $500. That's all.
Good day everyone. Today I'll be explaining how do we solve the applied problems for question 21. In question 21, we are required to find the new balance sheet for new bank. So the answer for this question is shown above. So in column for asset, we have three items, which is required reserves, assessed reserves, and loan. While in liabilities, we have checkable deposits and capital. So how do we find required reserves? In order to find the required reserves, we need to multiply 8% with checkable deposit, which is 100 million. Then we will get the final answer would be 8 million. And in order to find the assessed reserves, we need to add on checkable deposits and capital and subtract it with required reserves and mortgage loans and also the commercial loans. Then we will get the final answer, which is 48 millions. And the last one would be loans. So how do we get loans? To get loans, we need to add on commercial loan and mortgage loans, which the final answer would be 50 millions. While checkable deposits will be 100 million and capital would be 6 million. So in conclusion, the total for each asset and liabilities are 106 million. That's all from me. Thank you.
T-bills are money market security that the government of the nation issue to raise short-term capital. T-bills have a maturity of less than a year. So, the number of T-bills is equal to investment amount or trading value of bills. This is how balance sheet look before purchase of T-bills. The calculation of number of T-bills and effect on balance sheet. The table shows investment amount 45 million. Meanwhile, for the value of T-bill is $4986.70 and number of T-bill is 45 million divided by $4986.70 equal 9024. Since the T-bills are an investment for new bank, the amount invested in them will lower the excess reserve on the asset side of the balance sheet and add T-bills to the side of the statement. We will now show balance sheet of new bank after investment in T-bills, which is excess reserve after investment equal 48 million minus 45 million, so the excess is 3 million. In conclusion, the bank invests in the T-bill purchase making it an asset in the bank portfolio. Consequently, it is revealed on the asset side of the balance sheet. In order to reduce the surplus reserve amount, new bank will purchase T-bills that are considered asset.
Now let's move on to question 23. Question 23 is about X bank reported on ROE of 15% and an ROA of 1%. How well capitalized is this bank? Before we jump into the calculations, let me explain what is ROE and ROA. ROE is return on equity and ROA is return on assets. So, return on equity is equal to return on asset times equity multiplier, which is EM. So, when ROE is 15% and ROA is 1%, we have to calculate how much is the EM, equity multiplier. So, we have to divide the ROE with ROA. So, the answer is 15%. The equity multiplier is 15%. The relationship between the return on assets ROA and the return on equity ROE is linear. The return on assets measures how the bank is efficiently been running, and the return on equity measures the efficiency of the owners on the investment they did. The equity multiplier EM is the determinant of the relationship. So, the formula of EM is assets over equity capital. Since the return on asset is given by the question, which is 1%, now we have to find how many percent is the equity capital. Substituting the values in the formula given, which is EM as 15% and asset as 1%, we have to find the equity capital. Hence, 1% divided by 15%, equity capital is 0.66. We have to multiply the value with 100%. Hence, we get 6.66% as equity capital. As a conclusion, we can conclude that this X bank is well capitalized bank because the given return on equity exceeds the given return on asset, which is the return on equity capital is now 6.66%, which exceeds the return on asset, which 1%. If the ROE, return on equity, is low, a bank assumes that it has too much capital. If a bank has too much capital, hence the return will be low. Following this question, given ROE seems high, which means X bank is a low capital bank, thus higher the return for the owners of the bank. That's all from me. Thank you.